Good afternoon, everyone. Welcome to our webinar. I'm Alistair Dent. Joining us on the call today is Jonathan Tiefel. Really appreciate everyone giving up their time to attend our session today. Expect the webinar to last around 20 minutes and we'll wrap up a little before 1 o'clock. It's good to see the number and spread of attendees on the call. Really encouraging that so many are taking today's topic of cash flow seriously. I'll hand over quickly to Jonathan, and perhaps you can kick us off with a brief introduction of who we are, John.
Thanks, Alistair. So Quantum Advisory is a business advisory and accounting firm. We're based in New South Wales. We've got two offices, one in Windsor, one in Wollongong, and we service clients right around the country. We have clients in every state of Australia. Our focus is on growth businesses rather than just your standard tax and compliance. So today's topic consistently ranks as the #1 concern for small and medium enterprise, and that's cash flow. If you've never gone to sleep at night wondering how you're going to pay the bills tomorrow, you'll probably be in the minority. So our subject today is cash flow fundamentals, why cash is king, and how to manage it. Before we begin, let's take a quick look at the agenda for today's session. We'll be looking at why cash is king. That's a very well thrashed metaphor, but it's absolutely true. We'll then have a look at the cash conversion cycle, which is the journey of cash through your business and how you can speed that up. The 3F approach to cash flow. This is a framework you can use to improve your cash flow management. We'll also give you some tips on how you can survive a cash flow crisis. And finally, we hope to leave you with a cash flow action plan. So it's a plan of priorities you can implement in your business to increase and improve your cash flow. And finally, we would value your feedback at the end of the webinar. You will see a feedback form pop up at the completion of this session. If you fill out the form, we'll make these slides available to you, and we'll also provide our working capital optimization tool as well. And with that, I'll hand back over to Alistair.
Thanks, John. So the phrase cash is king has been around for a long time now, and it's as true today as it ever has been. Cash in your business equals liquidity, and liquidity gives you options. It gives you flexibility and room to move. On the flip side, a lack of cash and a lack of liquidity will restrict your business and hinder its growth. As you can see, cash flow management is far and above the #1 cause for business failure, 82%, you can see there on the screen. But unfortunately, my experience is that business owners typically don't give it the attention that it deserves. So we've all heard this before: revenue is vanity, profit is sanity, but cash is king. And mostly we're pretty proud of our revenue numbers, you know. We drive them hard, we track them every day, celebrate the wins, etc. But revenue doesn't pay the bills. It does not pay the bills. So then we look at profits to put some reality back into the situation. They're the real reason we're in business, of course, and profitability is absolutely critical. But on its own, it isn't enough. So then the litmus test of a good, sustainable business is cash flow, which means you need to place a premium on good cash flow management in your business. Poor cash flow makes you feel like this little guy, bobbing along just trying to keep your head above water. It's really tough going when you're in this position, slow moving, everything is a struggle. But when you free up your cash flow, you feel more like this guy, fast, agile, nothing can catch you. You may even have time to chase the odd gazelle or two. And the quote on the screen, I think, is a really good indicator of the importance of cash flow. Cash is like oxygen, and when you don't have it is when you really notice it. So your business can survive without profits, but it certainly won't survive without cash, which is why cash is king, and long live the king. So now Jonathan is going to give us some details on the cash conversion cycle.
Okay, thanks, Alistair. So once we have an understanding of the importance of cash flow, the next step is to get a solid understanding of how the cash flow cycle works. So let's take a look at the journey of cash through your business. Different businesses have different cash flow cycles. So a service-based business will have a different cycle to, say, a manufacturing or a contracting business. However, the same basic principles apply. We're talking about the period from when cash leaves your bank account to when it comes back in. The longer that cycle is, the more difficult your cash flow becomes. Here on the screen, you can see that cycle in a typical business. Firstly, you purchase some stock from your supplier. You'll have a window of time before you need to make payment for the goods. The goods will sit in your warehouse or be a work in progress until you make a sale to the customer and an invoice is finally raised. Only once payment is received from the debtor does the cash actually flow back into your account. What we're looking at here is how long it takes your business to convert cash out into cash in. This process is often called the working capital cycle, but we prefer the term cash conversion cycle. Your cash conversion cycle is simply a combination of your working capital metrics, so debtor days, inventory days, and creditor days. In the example here, the cycle starts with you purchase stock. This is day 0. You pay for the stock on day 44. However, the goods remain in stock for a further 66 days until they're sold on day 110. You then have to wait a further 62 days for your customer to pay you, finally on day 172. Your cash conversion cycle in this instance is 128 days, inventory days of 110, plus debtor days of 62, less creditor days of 44. This means you need to fund approximately 4 months of working capital. Slicing a few days off your cycle can do wonders for your cash flow. If you're looking to improve the cash flow in your business, you must get a thorough understanding of cash conversion cycle. So with that, I'll hand you back to Alistair.
Any business owner knows the symptoms of poor cash flow and, I guess, the flow-on effects to the health of the business. But what doesn't seem to be known quite so well is the best approach to actually improve the cash flow situation. So what I'd like to show you today is what I call the 3F approach. And this is a structured framework to get the best possible cash flow results out of your business. So when we talk about the 3F approach, we're talking about forecasting, funding, and focus. So let's just run through these very quickly. First F is forecasting, and this is the backbone of good cash flow management. Without it, there's no question you'll be flying blind. We would always recommend you have 2 cash flow forecasts for your business, and that's a long-term and a short-term forecast. So your long-term forecast really, I guess, guides your strategic decisions. This would be for a period of 12 months or more, a long-term forecast, whereas a short-term forecast guides your operational decisions, so your day-to-day decisions, and this would normally be a 3-month forecast. So those that attended our forecasting webinar last month may remember our 3 golden rules for forecasting. And those rules related to forecasting in general terms, whereas the golden rules for cash flow forecasting that you see on your screen are a little different. So we'll quickly run through them. Rule number 1 is keep it alive. So your forecast will be out of date very quickly once you complete it, very quickly. So we would always recommend that you keep it live, keep it current, keep it up to date, and to do that you need to roll it over regularly. So at least once a month, preferably I would suggest every week. Rule number 2 is success, not perfection. So when it comes to a cash flow forecast, just make a start and you can refine it as you go. We don't need too much detail, just keep it high level. I like to say, don't sweat the small stuff, just get the big numbers right and the rest will look after themselves. Then rule number 3 involves staying close to the numbers. So you need to be absolutely intimate with what's happening in the business and to be able to stay on track with your cash flow forecast. And that means it's difficult for somebody externally that doesn't have a great understanding of your business to be able to complete that on your behalf. So the second F is funding. The tight cash flow is not always a bad thing within reason. It can make you more diligent and disciplined in managing your cash flow, and it can also help cut down on cash wastage. However, when you get a situation where cash flow is too tight, it then becomes restrictive. And that means that it'll limit your options, it'll hinder your growth, and without question, it will suck your focus. So you need to make sure that you're not starving your business of funding. Give it what it needs. Give your business the funding that it requires in order to continue its growth momentum. And then your bank manager needs to be your friend. So a good relationship with your bank manager is a key part of good cash flow management. And I like to say that a crisis is no time to introduce yourself to your bank manager. If you do that, you'll be on the back foot right from the word go. But unfortunately, when things are tight and heading into crisis mode, this is the time when most business owners are looking for additional funding. So when you fall into this trap, it effectively means you're asking the bank for help at a time that they're least likely to provide it. So you need to get on the front foot. And then sticking with the bank theme, are you asking the hard questions of your bank manager? How long is it, for instance, since you've requested a funding review? Or perhaps asked about alternative funding, lower interest rates and fees? How about approaching another bank or a lender to see what they can offer? At the end of the day, you need to treat your bank as another supplier. You have to have a good relationship, but you also need to negotiate well. And then the third F is focus. Might seem a little bit obvious, but if you want better cash flow, you need to act like you want better cash flow. And this means actually spending some time and focusing on what is required to improve. So start with the low-hanging fruit. First off, these are things you'll be able to identify easily enough. Maybe diligent follow-up of some overdue debts, or perhaps turning slow-moving stock into cash. Maybe talking to some suppliers to negotiate better terms. But then the short-term fixes don't fix your structural cash flow problems. So you need to spend more time, more regularly, to implement structural improvement. For the most part, the best use of your time is improving your cash conversion cycle. As Jonathan brought up earlier, that's debtor days, inventory days, and creditor days. And the bulk of your cash flow improvement should be able to be found there. So spend some time, spend some focus, get it right. And then we can look at funding, spend some time, focus on it, simply knowing what is available in terms of fundamental improvement is not enough. You need to spend the time and spend the focus on actually making those improvements. Invest some time in actually improving the fundamental structure of your cash flow. Your business will certainly be the better for it. So with that, I'm going to quickly hand back to Jonathan, and he can go over how to survive a cash flow crisis.
Thanks, Alistair. That's great. So what we've covered so far today mostly relates to long-term strategies to improve your cash flow. In wrapping up today's session, we'll be looking at a cash flow action plan so that you can introduce some of those strategies into your business. But before we do that, let's take a look at what you should do if you're actually faced with a cash flow crisis. So the first priority is not to panic. You'll need a cool head if you want to get through your cash flow crisis. That doesn't mean that you're blasé about the situation or that you're not taking it seriously, but although a sense of urgency is required, knee-jerk reactions won't help. So don't panic. The second priority is an extension of the first, but you need to get the facts. Business owners often tend to base decisions only on the symptoms or sometimes just gut feel. Good decisions will be made if they're based on accurate information and proper understanding of your circumstances. Central to this, your cash flow projections and financial reporting. You must have a short-term cash flow forecast. This is a non-negotiable. Once you have that in place, the next priority is timely financial reports. You need to have an understanding of what the causes are for your crisis so you can move to resolve the issues. The third priority in a cash flow crisis is communication. Communicate with your team, ensure that they know what the situation is and that you need their help. Communicate with suppliers for more favourable payment terms. Definitely communicate with your accountant and with other stakeholders in the business. Open communication ensures that you have support in a difficult time, and no communication equals no support. The quickest way to turn your cash position around quickly is to slow down cash out and to speed up cash coming in. The first step here is to speed up the collection of debtors, so review the process and review your debtor listings carefully. Then you should set some targets around reduction in overdue debtors and really drive it hard. Typically you'll find the easy money is in the just overdue accounts. The next step is slowing down payment of creditors and other payables. Come up with a plan to string out the payment of creditors, spend some time to negotiate with suppliers, and consider entering into payment arrangements if they're available. The third step is to reduce new payables entering the system. So review purchase orders, review them closely before approval, remove or reduce investment in non-core stock lines, review your overhead costs and see what can be cut. And finally, don't be shy and don't shy away from making those tough decisions. Not knee-jerk reactions, as we've just spoken about earlier, but decisions that are required in order to see you through a crisis. Sometimes you have to weigh up the future of your business against other less important considerations. If you have to move someone on, just do it. Maybe there's an area of your business that's sucking cash and not delivering return. You really need to drop it. You just need to consider the health of the entire business and not make decisions in a vacuum. And with that, now Alistair can go over your cash flow action plan.
Thanks, John. We've covered quite a bit so far today. I guess it's a lot of theory. The question is, how do you put it into practice? And so with that, we've just got a very brief cash flow action plan, 8 points. Point number 1 is to understand your cash conversion cycle. It's absolutely critical. John went over it in a bit more detail earlier. It's critical that you understand that so that you can then make decisions to improve your cash conversion cycle and therefore improve the cash flow in your business. Point number 2, a short-term cash flow forecast, absolutely imperative. We said earlier it's non-negotiable. 100% you need to have a short-term cash flow in your business. Point number 3 is to have a 24-month funding map. So this would be a funding map tied to your business strategy. So no doubt you would have a strategic business plan stretching out into the future, 12 months, 2 years, 3 years. You must have a funding map which is connected to that strategic plan. Once you have that, meet your bank manager. So go to your bank manager with your funding map and have a discussion, have a conversation around what they can do to support you in your funding requirements. Point number 5 is investigate alternative funding. So in addition to meeting your current bank manager, look at your other options. Don't just have one string to your bow. Perhaps look at an alternative bank, an alternative lender. Find out what's available and investigate that alternative. Point number 6, review debtor management process. How much wasted cash is sitting in your debtors right now? Have a look at your debtor management process, see how it can be improved, see how you can have a consistent and thorough approach to collection of debtors in your business. Point number 7 is conduct an inventory analysis. So look at your stock listing and analyse it. Make your stock more efficient. Perhaps cut poor performing lines. Look at the stock turn for each individual stock line, and you'll find a huge amount of inefficiency that you'll be able to cut and improve your inventory turnaround, your inventory days. And lastly, point number 8, negotiate payment terms. So particularly if you have overseas suppliers, but certainly local suppliers as well, just have a conversation, speak with them, negotiate better payment terms. If you take the time, invest the time in actually doing it, you might be surprised at what is available and what can be done to improve the cash flow in your business. So with that, I'd like to wrap up. So just a 1-minute recap of what we've gone over today. We've had a look at why cash is king, the cash flow in your business. We liken to oxygen. You can't live without it, and when you don't have it is when you really notice it. We went over the cash conversion cycle, which is a journey of cash through your business. This involved understanding the key working capital metrics, that being debtor days, inventory days, creditor days. And the key takeaway from today should be the 3F approach to cash flow management, which is a structured approach to optimising your cash flow. We also looked at how to survive in a cash flow crisis for when you're really feeling the pinch. And finally, we've just covered off a cash flow action plan, how to set a plan for increasing and improving cash flow in your business. So we hope and we trust that this session today has given you some additional insight into cash flow within your business, not only the importance of it, but also what you can do to make a positive impact. As always, if you have any questions, you can reach out to any of our team. And before we go, just a quick reminder to fill out the feedback form. It should take you less than a minute. We're very keen to hear your thoughts on how we can improve and provide more value in these monthly webinars. And we certainly hope you can spare an additional minute of your time. We'll supply the slides from today and also a free copy of our cash flow optimisation tool as a thank you for filling that out. So we hope you enjoyed today. We've certainly enjoyed having you along, and we trust you'll join us again next time. Until then, thank you again and have a great day.